ever feel like to make it as a trader, you just got to be glued to those charts all day, every day?
Well, that's exactly what we're diving into today.
Yeah, today's deep dive is going to challenge that idea.
Yeah, we're going deep on some, let's say, contrarian wisdom.
Yeah, from a trader who's been around the block a time or two.
And he says trying to constantly, watch the charts and make trades, especially when you're still learning the ropes, it's a recipe for disaster.
Yeah, it's kind of like that saying, the best trades are the ones you don't take. You heard that one.
100%. He's all about quality over quantity,
Right.
waiting for those prime opportunities instead of just jumping into anything. And the way he spots those setups, he calls it daily bias.
Daily bias. Okay. So we're talking about trying to figure out which way the market's going to go, right?
Yeah, basically. But he's clear. This isn't about becoming some kind of market psychic, predicting the future.
Right, right. More like playing the probabilities and looking for guarantees.
Exactly. And he breaks it down into three main parts.
Yeah.
Weekly expansion, economic calendar alignment, and then top-down analysis.
Okay, I like the sound of this. So it's like gathering clues, right? Like a detective would.
Exactly. You got it.
Love it. All right. So let's start with this weekly expansion thing. What are we looking for there?
All right, so picture this. You put on your detective hat, right? And you're looking at the weekly price chart. What's the overall story it's telling you, right?
Yeah.
Is the market, like, heading towards a previous high or a low? Maybe there is some gaps in the price action.
Hold on. You're talking about those fair value gaps. What are those again?
Oh, yeah. So those are basically areas on the chart where the price is made like a really sharp, sudden jump, and they often point to potential manipulation in the market.
Interesting.
Think of it like someone pushing their way to the front of a line,
Yeah.
It leaves this gap in the natural flow.
Okay, I get it.
Right.
So with this weekly expansion thing, we're basically looking for those big picture clues to try to get an idea about where the market might be headed next.
Yeah, exactly. You're not trying to predict the exact price or anything. Just get a sense of the general direction it might be leaning.
Right. Okay. Gotcha. But it doesn't end there, does it?
Yeah.
I mean, we're not done with our detective work yet.
Not even close.
Yeah.
So once you've got those insights from the weekly expansion, got to line those with the economic calendar.
Which is where it gets really interesting, I bet. Because we all know news can really shake things up.
Oh, absolutely.
Yeah.
This is where you got to find those, high-impact news releases, like the reports that could really move the market.
Right. Big economic reports, interest rate decisions, that sort of thing.
You got it. Those are your triggers. They can really unleash some volatility. And knowing when they're coming, that's like having a secret weapon.
Okay, so I'm starting to see the bigger picture here. We've got this potential move from looking at the weekly chart. We've got the timing from the economic calendar. Now I'm guessing this top-down analysis. That's where we put it all together.
You're catching on quick. You're like a natural at this.
I wish.
So this is where things get really, really granular, okay? Top-down analysis, it's all about connecting the dots. We're taking those big insights and bringing them down to the level of an actual trade.
So we're literally going from like the weekly chart down to, what, the 15-minute chart?
Yeah. Or even lower. Think of it like, fine-tuning a radio signal. You start broad, and then you just zero in on the exact frequency.
Okay.
So you're confirming your bias as you go down through the different time frames.
Yeah.
From the weekly, maybe to the daily, to the 4-hour chart.
And then all the way down to those shorter time frames, like you were saying, so you can pinpoint your entry and exit points.
You got it. But it's not just about finding any old entry and exit, right? This is where those technical analysis skills really come into play. You remember those fair value gaps we talked about earlier and those order blocks?
Oh yeah, those are starting to sound familiar. Those are all about finding those support and resistance levels where the price might reverse, right?
Bingo. It's like another layer of confirmation for your analysis. It really helps you pinpoint those high probability setups.
So we're looking for that sweet spot where your technicals line up with these potential areas of, market manipulation. It's all starting to click now.
Get this.
What?
To really drive this point home, he actually walks us through a real trade that he made, the dollar-Canadian dollar pair. It was back in June 2022, around some key economic data coming out of Canada.
Oh, really? Wait, don't leave me hanging. You got to hear about this. All right, so paint us a picture here. Set the scene. What's going on with this dollar-CAD trade?
So it's June 21st, 2022, and our trader, he's watching the Canadian dollar really closely because there's this big economic data release that morning. Core retail sales.
Ah, okay, so this is where their whole economic calendar alignment comes into play, right?
Exactly.
He's not just picking a random day to trade the Canadian dollar. He knows this data release could really make things interesting.
He's looking for volatility for sure.
Yeah.
And this news event, it's like a potential catalyst. But here's where it gets even more interesting. In the hours leading up to the release, he starts to notice something fishy.
Fishy, how? What's going on?
The dollar CAD pair, it starts surging higher, but it's not like a normal, gradual move. It's more like a sudden, sharp spike,
Okay.
almost like someone is deliberately pushing the price up.
So if I'm picturing this on the chart, we're talking about one of those fair value gaps you mentioned earlier, like this big void where the price has suddenly jumped.
You got it. And he recognizes this pattern. He knows institutional traders, they use this tactic sometimes to create what he calls a liquidity trap.
A liquidity trap. Okay, now that sounds a little ominous. What is that exactly?
Okay, so think about it like this. They drive the price up, right? And that triggers all these buy orders from traders who think, oh, this is a breakout, got to get in now.
Right.
But as the price keeps climbing higher, it starts hitting the stop-loss orders of all the traders who are short, just adding fuel to the fire.
Yoch, yeah.
And then right when everyone thinks the price is going to the moon,
Boom. The news drops.
the rug gets pulled out,
Yeah.
the price plummets back down, and all those traders who bought into that fake breakout, they're left holding the bag.
And I'm guessing the institutional traders who started this whole thing, they're buying at the bottom.
Bingo. They made a killing. First, by selling into that rally, and then by buying back even cheaper after the news. I mean, it's like they rigged the game.
Totally. So what I'm hearing is, don't get played.
Exactly. And that's what's so valuable about this. He's not just telling us what to think. He's showing us how these moves actually play out in the real world. But it gets even more interesting. He doesn't just stop with the dollar CAD, right?
Yeah.
He uses this trade as a way to show how powerful intermarket relationships can be.
Okay. Yeah, you mentioned earlier that he was watching the S&P 500 futures at the same time. What's the connection there? How does that all tie together?
Okay, so he explains that a weakening U.S. dollar, which is what a falling dollar CAD would suggest, that often lines up with what traders call a risk-on environment in the market.
Because if investors are feeling bold, ready to take on more risk, they're more likely to move away from the US dollar and put their money into other places, like stocks, for example.
Exactly. So he's seeing this potential manipulation in the dollar CAD, which is pointing towards a weaker dollar.
Yeah.
So at the same time, he's checking the S&P 500 futures to see if that risk-on idea is showing up there too.
Yeah.
The S&P, totally flashing bullish signals.
Wow.
It's like a confirmation for him, putting the pieces of the puzzle together.
So it's all about connecting the dots. He's not just looking at one little market in isolation. He's seeing the bigger picture, right? Understanding how all these different things influence each other.
And that, my friend, is the beauty of intermarket analysis. But he leaves us with this little puzzle, like a brain teaser, right? He says he wasn't looking at the Australian or New Zealand dollars that morning, but, if he were. And then he just kind of trails off.
Ooh, I see what he did there. He's making us think, isn't he? So let's break this down. We've got a maybe weakening U.S. dollar, possibly pointing to a risk-on environment. Now we got to think about where the Aussie and Kiwi dollars fit into all of this. They're both commodity currencies, right?
You got it. And they're both really influenced by commodity prices, especially what's happening in China.
So if the U.S. dollar is potentially getting weaker and we're seeing strength in commodities, what does that mean for the Aussie and Kiwi?
That's the million-dollar question, right?
Well, I mean, if commodities are in demand and the U.S. dollar is down, wouldn't that mean the Aussie and the Kiwi would probably strengthen against the U.S. dollar?
Sure seems that way, right?
Yeah.
He's given us the clues. Now it's up to us to put them together.
All right, let's talk about the thing that makes every trader a little squeamish, shall we?
You're talking about money management.
The dreaded M word. It's kind of the unsexy side of trading.
Yeah, for sure. But you know what? I've found it's often the difference between those traders who, consistently make profits
Right.
and those who, well,
Yeah, let's not sugarcoat it.
not going to name any names.
Exactly.
But our trader friend here, he seems to agree with you. Like, he really emphasized this. I mean, he actually spent a whole session of his course on money management.
Wow. All right, so lay it on me. How does he approach this?
He starts off, honestly, by getting kind of personal about it.
Mm-hmm.
He admits that when he was younger, early 20s, he fell into that trap of, like, chasing every single trade.
Oh, yeah.
Ignoring risk, thinking he could outsmart the market.
Been there, done that. Not pretty.
Yeah. You live and learn, right. But those learning experiences, sometimes they can be expensive.
Painful, too. All right, so what was his wake-up call? What changed for him?
He had to learn the hard way, let's just say that,
Ouch.
through a whole bunch of, pretty costly mistakes.
Ah, yeah.
But eventually he kind of had this epiphany. He realized success in trading, it isn't about winning every trade.
Wait, really? I thought that was the whole point.
That's what I thought too, be right as often as possible. But he says that's actually a total misconception. He's more focused on managing your risk effectively. And get this, he even says you can aim for a win rate of less than 50%.
Hold up. Did you say less than 50%? Like, you're telling me you can be profitable even if you lose more trades than you win?
Yep, that's exactly what I'm saying. It all boils down to this one thing, risk-reward ratio.
Okay, yes, risk reward. It's like the holy grail of trading. We all know it's important. But in practice, how do you actually use this thing?
It's all about making sure that when you win big enough to offset any losses you might take, right?
Yeah.
So let's say you're risking $100 on a trade. You should be aiming to make, at minimum, double that, $200.
Okay.
So that's a risk-reward ratio of 1 to 2, or better, right?
Right. 1 to 2, yeah.
So even if you only win, say, 40% of the time, if your risk-reward ratio's on point, you can still come out ahead over the long run.
See, this is why I love this stuff. It's like it takes the pressure off a bit, you know? It's not about being right all the time.
Exactly. That's the whole beauty of it. You're shifting your focus. It's less about predicting every little move and more about setting yourself up to win over time. But
There's always a but, isn't there?
just a small one. How do you actually figure out the right risk-reward ratio for a specific trade?
Right, because it can't just be random, can it?
Definitely not. It's got to be tied to your analysis. So remember those fair value gaps and order blocks we talked about?
Yeah. Those were for more than just spotting manipulation, right?
Right. They also show you those key support and resistance levels, where the price is more likely to, reverse. So you're basically using those levels to help you figure out your entry point, where you put your stop loss, and where to set your target. You're basically letting the market tell you what to do.
So it all ties together. Cool. But there's another piece to the money management puzzle too, isn't there? Position sizing.
Ah, you're on fire today. How much are you actually risking on any given trade? That's huge. And our guy, he's a big fan of what he calls the 1% rule. Never risk more than 1% of your total capital on a single trade.
Okay, so if I have a $10,000 account, I'm not risking more than $100 on any one trade.
Pretty simple, right?
Exactly. Simple, but so effective. It just helps you avoid those really painful losses, the ones that can, really set you back.
Right, especially when you're just starting out, too. Exactly. He does say it's more of a guideline, not like a hard and fast rule.
Okay.
Some traders are a little more comfortable with risk. They might go up to 2%. Others might be even more conservative, stick to 0.5%.
So it's about finding what works for you and your own risk tolerance.
100%. And being willing to adjust too, right? Because we know markets change all the time. Your risk management should probably change with it too.
It's funny. We often get so caught up in the excitement of trying to, find those buy and sell signals
Literally.
that we forget about this stuff. But honestly, this is the foundation, isn't it?
It's all about the mental game, really. Keeping your head on straight when things get crazy.
Because we know it can get crazy.
Oh yeah, trading can be a wild ride.
That's a good way to put it. Well, I think that about wraps up our deep dive for today.
I think so, yeah.
But remember, this is just the beginning, right?
Yeah.
Take this stuff, try it out, see how it works for you.
Absolutely. Put it into practice.
And until next time.
Happy trading.